Hi everyone, welcome back. It's Paul Tilley, and today we're talking about the very first unit, Chapter 1, in AC 1260, Financial Accounting 1. This Chapter 1 is really two basic issues, and I've broken it into two sets of slides. The first issue deals with the theory of accounting, and the second issue deals more with the process of accounting, okay? So what I want to talk to you about is some of the rationale behind why we're doing accounting and what relevance accounting is to the business world. So what exactly is accounting? Well, accounting is an information system that really identifies, measures, records, and most importantly, communicates information that objectively and correctly represents how the organization is doing its economic activities, more or less. Can't be overstated how important the objectivity of accounting is. So we need accounting to be able to be objective in the sense that if you're going to record my books in my company and you're going to record your books in your company, that the processes are the same. So we can compare apples with apples. We can look at a business and say, for example, that it's doing well. We need to be able to make sure that same standards applied to the calculation process. So one of the things that a lot of people get confused in is accounting just bookkeeping? Is it record keeping? Well, it's much more than that. Because record keeping or bookkeeping is really the recording of financial transactions either electronically or manually. What we mean by electronically is using a program like an accounting program like Simply Accounting or something along that lines that would allow us to do the actual transactions. Or we could manually do it. Some people still do it manually. But the fact of it is that the bookkeeping is really focused on the recording. But accounting involves taking those records and using them to be able to make some business decisions, okay? So it's very much focused on what does it mean? What are the implications of this? How can we change direction or adjust our business to reflect the best possible course of action? One of the things that we really need to appreciate is that not all organizations are the same. Different organizations will have different needs for accounting. A sole proprietorship, for example, is really an entity with one owner. And it's separate in terms of the owner and his or her things and the business and the businesses. We need to think of the business as kind of a separate person. So it's not separate in law, though, from a legal point of view, but separate in terms of the accounting. The thing is with a small business is that it has unlimited liability, and that poses some challenges for a lot of people. And the thing is, the life of the business is limited to the life of the owner. If the owner dies, the business dies with it. And one of the things that we look at is the taxation of a private sole proprietorship is no different than someone working for someone. It is applied the same way. A form of sole proprietorship, which more than one person is involved, is known as a partnership. And a partnership really has two or more people owning the business and working together to create something. It's very similar to a sole proprietorship in that it is separate for accounting purposes, but not separate in law. Okay? And there's unlimited liability, and really if one owner indebts a company, the other owner is equally responsible for those debts. And like the sole proprietorship, it has a limited life, and the owners are taxed on the profit just like they would if they had an income. In terms of a corporation has one or more owners too, but the thing is with the corporation is it is a separate entity not only for accounting purposes, but in law as well. It is a legal person. A corporation is a legal person. And that means that it has some degree of freedom to do things that a sole proprietorship or partnership can't. One of the things that it has in terms of an umbrella is limited liability, meaning the owners can't lose any more than they put into the business. And it also, the life of a corporation can go on forever past the life of the owners. However, corporations are more complicated to set up and complicated to arrange. And the taxation system is different with regards to corporations, and we need to think about, is this worth the trouble for a small business? In terms of users for the accounting information, we're pulling out all kinds of data who's going to use it? Well, all kinds of people: lenders, shareholders, government, consumer groups, external auditors, customers. Could be considered as all external users. Internally, we got officers, managers, internal people. All of these things, including sales staff, budget officers, and controllers, are going to have a big input. You got to think about the external users as having outside looking in perspective. And really, they're relying on the accountants to use these standards that we talk about in order to present a fair picture of the company. So if they're going to potentially buy into it or work for it, they want to know, does the financial statements represent the true reality of the business? Ethics and social responsibility have become a big issue in business over the last number of years. In terms of accounting, what you're doing is, as an accountant, you're representing the financial health of the business. And if you're going to tell someone that the business is healthy, it darn well better be healthy. So in terms of ethical behavior, accountants need to ensure that they use the GAAP methodology and the principles of GAAP to ensure that they are presenting a fair picture. And that means investors and banks and government won't be misled in the process. So I've spoken a little bit about GAAP, but let's look at GAAP in a little bit more details. Well, generally agreed upon accounting principles, or GAAP, is really the underlying concept that make up acceptable accounting practices. Every student should be aware of what GAAP is and what its purpose is, okay? So Canada has recently adopted some international standards called IFRS, and effectively it's GAAP worldwide, okay? But for our purposes, we need to be aware of what GAAP does. So the primary purpose of GAAP is to ensure usefulness in financial information, and in order for it to be useful, it must have a qualitative characteristics of relevance and faithful representation. In other words, it needs to be the right information at the right place, correctly placed for the right users. And it has to be useful by the fact that it's comparable, verifiable, timely, and understandable. We got to be able to compare it with other companies. We got to be able to check it to ensure that if a number of people did the measurement, it would come out the same. It would have to be relevant with regards to time, meaning that if you're going to give me financial statements, no point to tell me how the business was 10 years ago. What is it like now, or what was it like last year at the latest? And understandable, meaning that the general public or someone who's not trained in accounting can look at it and be able to see why a certain conclusion. With regards to GAAP framework, the GAAP framework has a lot of key points to it. The first one is the reporting entity, and that is every business is to be accounted for separately from the owners. So we don't want to muddy the waters by having owners put in money and not have it recorded. The separate entity concept needs to be in place so that we can record the revenues and expenses that are generated by that business. In terms of cost constraint, the cost incurred in reporting financial statement information must not outweigh the benefits received from the value of that information. I'm sure that we could, get super accurate information, but how much would it cost to do that? So we need to be able to find a balance between a practical system and a fantastic system. We also have this going concern consumption, which is really that the business will continue, and it will continue into the future. And currency requires that transactions be expressed using the common denominator of dollars. What are the dollars or pounds or wherever we are, but using the units of money that are common. It assumes the monitoring unit is stable too, that money isn't always changing value. And adjustments are not made for changes in currency value or inflation. And again, that is a controversial one, but effectively what we assume is a dollar is a dollar is a dollar. As I mentioned, the revenue recognition principle, it requires that revenue be recorded at the time that it's earned, regardless of whether cash flows or not. When we talk about measurement, we're really looking at three things. Historical cost, when you bought it, this is what you paid for it. Currency cost, which is really the cash that would cost to acquire the asset now. And realizable value, how much could you actually get for it if you sold it? In the next section now, we'll look at some of the mechanics.